Welcome back to Uncontested Investing. Today we have Charles Farnsworth, a real estate finance expert with over 25 years of experience. A University of Puget Sound graduate, Charles founded a finance company, raised private capital, and spent a decade in corporate banking and wealth management. Now he leads 1892 Capital Partners' private lending operations. Tune into the episode for invaluable insights from his extensive career in real estate finance. Charles, thank you so much for joining us on the Uncontested Investing desk today. It's a pleasure to have you here, and I can't wait to get into this episode. First, what I want to do is sometimes I like making up awards for podcast guests. You might have attended the best university, so let's start with your origin story at the University of Puget Sound. What was the motivation? Right after college, a lot of people are thinking about joining a company. You actually started a finance company, so can you kind of take us back to those college days, what it was like attending the University of Puget Sound? I went to UConn. It's just farmland as far as the eye can see. So you were a little bit of a step up. Let's talk about the beginning of your journey.
Sure. I'm originally from Honolulu, Hawaii, so going to Washington State was a bit of a stretch. I was one of those kids who didn't know what I wanted to do in college. I always met some of those kids who knew exactly what I didn't know what I wanted to do. So it was a great university, but I was looking forward as soon as possible to get out and do something. And I started real estate while I was at college, essentially. I worked for a guy who was rehabbing homes. I'd go and help demo them. And then as I was sort of approaching my graduating year, I figured that's something I can do, right? I can fix home and I can sell it. So that's what I did. That's kind of how I started my career, and is doing fix and flips early on before it was what you might call fashionable.
Yeah. Before they made HGTV shows.
Yeah, that's probably what I should have done, but that's not what I did.
Yeah, just a few miles south, you could have been in Hollywood.
Yeah.
So with your professional expertise, the difference between secured private debt portfolios and working in corporate banking, can you kind of explain that? I even had to look down at my notes to make sure I was reading that right, but some pretty confusing terms. Can you kind of, in plain English, kind of explain the differences between those?
Yeah. Back to my college days when I was fixing and flipping homes, I didn't have a lot of money. So I had to figure out how I'm going to get access to capital to do it. I didn't have a W-2 job. Banks weren't lending in that way. And so I started borrowing money from private investors early on. And then I started realizing I could either continue to fix homes or I could sort of place money. And I would run into more investors who were fixing and flipping homes, and they were looking for money. So I started placing money that way. What you find quickly in the capital side is the way you raise money and what you use it for is largely driven by either shareholders or your vested parties, right? Mm-hmm. So private capital is very different than banks. Banks, they have the FDIC, they have shareholders, they're measured by different things. Generally, it's cash flow, and it's commoditized, and they all follow each other. There's strict financial covenants to borrow the money. They only generally lend to the best clients. So that leaves people like me out of college trying to fix and flip homes with no access to that capital, right? And so I started using investor money, and investors, I think people who are watching this podcast are probably falling in that category of how do I get in this business and what's the best way to get started. That's the path that I recommend you first use. And, RCN is a great company for that. We fill a different niche. But I started with friends and family, like people I knew, and as you get a little bigger and as you get a little more cash flow and you get a little more cash reserves, you can sort of move up the food chain.
Yeah.
But yeah, it's private capital is a good place to start.
Nice. So that brings you to your journey with 1892 Capital Partners. You're a director there now, and I love this, so I had to make a note of it and ask it on the interview. You self-describe it as a lender with a limp. So you kind of talked about your experiences all the way, through college, after college. How important do you think it is to have those experiences, go through challenges? This isn't always smooth sailing in the real estate investment space. So how important do you think that it gives you a little bit of a character, I would imagine, or it gives you a little character going through those challenges?
Definitely. I've been doing this since 93, 95, doing a long time. 2008 was a pretty difficult time for a lot of lenders. Some got crushed, some got disabled, some made it through, and those that made it through did really well. But I was in the middle. I got my leg didn't work after that. It was a really tough time, and when you live through environments like that, you get a sense that bad things can happen, and bad things happen to good people all the time, and often they're outside your control, right? And so living through 2008, lending, understanding those things can happen, really tempers your hubris, which is not something that real estate tolerates very much. You have to be very cautious constantly. And I think right now, over the past 2 years, there's a lot of lenders with limps right now because we've all had to try to adjust again to another market that we had absolutely no control over. There's no historical data that you could have pulled to make a business decision on whether or not you should continue to do this business because we've never seen rates do what they've done before, right? And so, but prior to that, any lender that got in the business 2010 and above, you could have underwritten in often many different ways and been very successful at it because the market was going up year after year after year and solving lenders' problems, generating returns that, they didn't expect, which drove a lot of capital into the space. And now I think everybody's trying to adapt, right? And I think the next couple of years are going to be interesting because I think we're just starting to see the real impact of what that interest rate rise has done.
So going back to 2008, I'm so new in this industry. I started in 2020 myself. So I always like hearing insight from people that actually went through that. What was your mindset when that was happening? Was that something where you maybe thought of changing professions? I can't imagine. They make movies about it now. It
Big Short's a great
It is. So I mean, it's going to go down in history as a marker in U.S. economic history. What was your mindset like during that time, if you don't mind sharing that?
No, I was at that age where you're swinging for the fences, right? You can do big things, accomplish big things. And so I had a very large mortgage shop in Hawaii when that happened. And we were ready to turn the spigots on and make a ton of money. And when we turned the spigot on, all capital dried up. So people into banks, everybody's suing each other and forming loans. And, that whole market came about. Prior to that market, subprime kind of became the thing that private capital was. Before, when I was borrowing money from individual investors, people make great returns. Subprime sort of saw that. Capital markets saw that. They started developing products to fill that gap. Private capital didn't exist because you could borrow money for nothing and high loan to values. And so private capital vanished. And so during that time, I was in banking because private capital, really, there wasn't an industry for it. But after 2008, I knew that private capital was going to be needed again because there was absolutely zero money, right? And so, I did have to completely reestablish myself. I had to shut down big operations. I had to deal with lawsuits. I mean, it was a terrible time. And then start going back to my roots, which was, bringing private investors together, encouraging them to lend their money to people, encouraging people to buy these properties from banks that were literally giving them away. And then since then, you just saw this meteoric rise of private capital. It just evolved into a different, so they don't use the word subprime anymore, but it's out there,
So I appreciate that insight. I like talking about that because there's a lot of investors right now on the fence. Should I get started? Should I not? Maybe going through a tough time. Their last deal didn't go the way they wanted to.
Right.
And I just appreciate the insight from somebody that's gone through one of the toughest times, if not the absolute toughest time, and is still in the industry, is still succeeding. So thank you for sharing that. One thing that you hit on, though, with private money is there had to be rules, regulations, things in place to make sure that doesn't happen again. So from your perspective, how far has the industry come in that regard of making sure something like that won't happen again, thanks to regulations and keeping tabs on things and not coloring too far outside the lines?
That's actually a really, really good question. I could probably speak for hours just on that itself. I noticed a similar smell in the air maybe 4 years ago. The regulatory environment in retail mortgages, meaning primary home mortgages, it's solid. It's underwriting's difficult. I understand the business very well. Highly regulated. Private capital, though, is now underneath the sheet.
Mm-hmm.
You can't see it. Business purpose loans are not regulated. It's still a bit of the Wild West, but people taking investment risk, that's what it should be. People want to generate returns, you need risk, and they structure deals the way they want to. But what I started noticing a while back was, values kept going up and up and up, and I was getting concerned. Even on our marketplace, the prices of homes, I would never have expected to hit such meteoric prices. Even before rates were 3%, things were going up. And I think there was actually an impact from the private capital market from that, because every private capital market's ordering appraisals, but those appraisals didn't have to be regulated.
Yep.
They were all using the same appraisal companies, and everybody's prices have been going up. And ultimately that hits that sheet where the retail market, and so it's going to impact those valuations, right? So it's actually percolating from below. And so I got a little nervous, but then rates went down to 2 and the whole market got turned upside down. And, it's right now if you had to ask me, where I think things are going to go or what's going to happen, I really wish I could tell you. I really do. But nobody knows. There's so many things that are happening right now in this industry that you can't predict. There's nothing historic we can look back on. So everybody's trying to predict. And there's where hubris becomes a little different,
yeah.
dangerous thing. Like, I know it's going to, I honestly, I wish I did.
Yeah.
So, yeah.
So on that subject, we talk about, the risk, the return on investment. What's the balance you look for, the process you go through when you're looking to secure an investment opportunity for 1892? What does that look like when you're juggling risk and reward? Are there key factors? Are there something that you're looking for? Talk to us about that process.
So when it comes to the risk and reward factor, we generally try to pursue properties that we are comfortable with the collateral, clients of good character, and a deal that is simplified, and then try to achieve the greatest returns for those 3 variables.
So while we're on the subject of return on investment, making some money, we're going to dive into the Money Making Minute. We're going to take a quick break for our ad read. Our sponsors are going to jump in here, but we'll be right back with Charles Farnsworth. Thank you so much for your time. I'm looking forward to what you're going to bring for the Money Making Minute.
Sounds great.
Need funding yesterday? 1892 Capital Partners is a direct hard money lending firm offering funds for modern real estate builders, brokers, and investors. With over 30 years of experience in real estate development and investing, they have been there and funded that, offering a unique perspective from both sides of the deal. What sets them apart is their independence, utilizing their own capital, allowing them to remain flexible and meeting the demands of real-world projects. Get approved, get building, and get growing today. Contact them for your portfolio needs. Welcome back to our Uncontested Investing listeners. I'm joined by Charles Farnsworth, Director at 1892 Capital Partners. And Charles, we're going to get right into it. It's the Money Making Minute. So this is an investment strategy app, skill, piece of advice, a daily part of your routine, anything that you think attributes to your success that you can maybe share with our listeners, allow them to be more successful, maybe starting tomorrow, next week, throughout the rest of 2024. Your Money Making Minute, let's hear it.
That's a big question and a great question as well. I think in order for investors to make money in real estate, there's no one specific thing. I wish I had a secret formula. I think it really largely has to do with what your goals are that you're trying to achieve, where you are in your life, what resources you have, what kind of person you are, what type of risks you're willing to take, how long your time frame is. And I actually enjoy spending time talking with investors about that. And I recommend a lot of investors try to find a coach, somebody who has a lot of years of experience who can help you navigate what is the best thing to do at any one point in time. For example, when I started, I didn't have any money. I didn't have anything. I didn't know what a mortgage was. I picked up books. I tried to learn it. And then I borrowed the money from somebody. I didn't have I was living deal to deal, and so that's a unique situation. Not all clients are living deal to deal. Living deal to deal presents its own unique sense of challenges and risks and discomforts. You need another deal to essentially pay your bills and then save some and then buy another deal and keep going and keep going. If somebody told me you ought to buy real estate to buy and hold, I would not have been able to do it. I just was not in that space, time, resources to do that. So depending where you are in the life cycle of real estate investing, what you're trying to achieve, largely dictates what you should be doing or what your secret sauce is, right? Most people start with fix and flips. And obviously, if I were to give somebody best advice who's getting into this business right away, it's, again, stick to simple things. Fix and flips are great. Ones that have what I would call a skin flip. No major added value, no major disease that needs to be cured. You can put paint, cabinets, countertops, carpet, sell it, turn it, do it fast, do it as fast as possible, do as many as you can do, save up your cash and resources to then move into the next stage, which is often buy, hold, rent, more passive investing, having the real estate work for you, which then moves into other things. Some people get into multifamily, get into duplex. So there is a process and evolution, and it just depends on exactly where you are, but you got to love the business. You got to be passionate about it. You have to constantly be looking at what's available to you and resources that are available to you. I recommend always hitting for singles. A lot of people, singles meaning don't try to make a ton of money, get into a really conservative investment, one that you can get in and out of, you make some good money on it. In the process of hitting singles, you'll often hit doubles, triples, and home runs. But what you hear a lot on these podcasts and stories is the one deal that made somebody a lot of money and propelled them into, doing more and more complex transactions. But I wouldn't say that happens to most people. And if you swing for the fences, in my experience, and this is me personally, you foul out in real estate, it takes a lot to get back to square one, and sometimes fouling out puts people out of business for good. And so I recommend people go for singles, look at it as a lifelong process, and just make really safe decisions on as many deals as you can.
Charles, great answer there. I think you brought up a lot of important points that investors need to always keep in mind. A little bit of a code to live by, or a creed to invest by, if you will. One of the things that I thought you discussed that I want to elaborate on, though, is finding a coach or a mentor, or doing the work through education. Do you have any mentors that you can think back on, or times in your career, maybe educational outlets? What were some of the things that helped you get to where you are today?
So I'm dating myself, but back then there wasn't the internet, right? So it was challenging. When I first started doing fix and flips, my first deal I got from a wholesaler, because I really didn't know much about real. I didn't even know what a mortgage was. And he kind of, fortunately, didn't take advantage of me and showed me a little bit of the ropes, because he wanted to get a yield and he wanted to sell more projects to me, and so it kind of worked out good. But I think right now the industry's changed a lot with the internet. I mean, the family, the two brothers that operate the business, they're a little younger than I am. They watch a lot of podcasts. They watch a lot of these types of shows, which I honestly wish I had more time to watch them. I just don't, but I try to, especially when they refer ones to me they think I should watch. I think those are really helpful. But you're still trying to seam a bunch of stories together, right? And you'll hear someone else's story and you'll think, if I can copy that story, But in my experience, people get to the places in ways that you don't understand a lot. And so I think it's to be able to have a conversation with somebody and have them parrot back where you are, what's going on, and challenge you. I sadly don't know I don't know where the best place to get a mentor coach like that is. I do spend a lot of time with clients. Sometimes they call me, and be happy to chat with some people that want to call as much as I can pick up the phone and help them. But I think that's what's attributed to a large part of my success. I try to pay it forward. I love the business. I don't want anybody to make the same mistakes I did if I can help people achieve that, then they'll be much further ahead at a younger age, so.
It's so important for investors to hear an answer like that, right? The pay it forward aspect of it. There are so many people out there that are doing it and they don't even realize it. Like you said, it's something that just kind of happens naturally in your position. You're not outwardly seeking to be somebody's mentor, coach them through something, but, through picking up the phone, navigating through a couple deals together, that you're kind of helping without even realizing it. So the help is out there. The investors just kind of have to be proactive, find the deals, be willing to accept the help and the advice that some people that are more seasoned in the industry are willing to give them.
Yeah.
So we're going to transition to your experience. You're a VP in corporate banking. You've been in private wealth management. How do those experiences kind of translate to where you are now with private investing in real estate and raising private capital? Are they completely different ball games? Are there things that you think back on, lessons you learned, skills that you may have had in those other industries that translate to what you do today?
Yeah, I'd say the most interesting thing that I learned in wealth management, because when I was in real estate, I was trying to make money. I was trying to generate wealth, right? And I also saw real estate as a way to generate wealth. What I learned in wealth management is there's a whole, because I work for family office now, their motivations are entirely different, right? They're all about principal protection, good yields. The best way to make a return in preserving wealth is avoiding tax. That's a guaranteed return, right? So you want to be the great tax person that has great tax strategies and great ways to pay the appropriate tax and not more than you need to. But the next thing is, investing in something that has a principal protection that gives you great yield, right? And I learned that private debt was that essentially best vehicle for that. And so, I embraced that as sort of the thing that I have to offer, and attracted investors who were in that position, I just want my principal protected. I don't want to lose it. It's okay if I don't get my yield even. I'm happy with it. I just don't want to lose my fishing bait because then I can't fish anymore. And those people are also generally at an age where they're not working anymore. They can't generate that income anymore. They cannot afford to lose that, right? And so it's a great investment for that. But got to find good operators and you got to find good companies to invest in that do that for you.
So I imagine with your experience, there's a lot of creative solutions or strategies when it comes to raising capital. One of the things that we talked about before the episode was fractionalized deeds of trust.
Yep.
Is that something you can elaborate on? Maybe give some insight to our investors out there about creative ways to find that money? I think you've hit on a lot of great ones so far, but that one in specific maybe.
Yeah, I think the fractionalized deeds trust is a good place for the beginning investor who's trying to raise. That's how I started, right? I had one investor had fund deals, and then eventually an investor came to me, wanted to buy property, and I had an investor who had a certain amount of money and another investor had a certain amount of money, but not enough to fund the deal. So you put two into a deal, right? So you fractionalize a deed into two investors. That presents a whole other host of other problems, though, depending on what state you are. That's considered a security. So you want to be sure if you're doing that, you're doing it properly, because that can be a problem for you. In Washington State, at the time when I was doing it, there was an interstate statute that allowed you to do that. You just couldn't raise money outside the state, and you had to provide certain prospectus information and disclosure things to these investors. They had to be accredited investors, all these other issues. Back then, though, the reason why that was a preferred vehicle, which is 95, small balance real estate funds didn't really exist. So there weren't a lot of them. They weren't as prolific as they are now. Small balance real estate funds, as you know, it's a pool of mortgages, and you're investing in a fraction of a pool of mortgages, right? Fractionalized deed of trust is you're in a specific property. So you get to see what that property is, what the loan to value it is, and that is your security. It's a much more difficult process. Back then when I was doing it, there's a lot of paperwork, assignments. It was very cumbersome. Funds showed up because it was a less cumbersome way to raise and move money. But ironically, they're kind of making a bit of a comeback because with technology and the internet and being able to assign those and manage those interests using technology, electronic recordings of assignments, all the things you'd have to do to run around that make it very cumbersome before, it is less cumbersome. So you have two types of investors out there, which are some that want to be directly invested in a deal and some that want to be in a pool. Just depends.
With the deals at the forefront, I think we got to jump right into it. The next segment is going to be deal breaker. deal maker. So for this one, what I really want for the audience to understand is, what are some characteristics that maybe cause a real estate transaction to break down? What are some things that they really need to avoid when they're trying to get across the finish line? And what do all successful deals have in common? Is there one trait that really shines through? Are there a couple things? So for your deal breaker, deal maker, what does that look like to you?
So I'd say a good deal is one that's simple with the fewest moving parts. So let's break it down. I think for a typical investor, that's going to be like a fix and flip project that doesn't need a lot of work. Your budget, if you're spot on with your budget and you're spot on with your exit value, and this is where realtors become of real value to you, those 2 points are essentially the function of what you want to pay for it. So if you're accurate in those 2 pieces and you're really good at that, you'll make money on every deal. When you're starting into rentals and trying to anticipate rent, you're adding more complexity to that. And again, the more complex the deal is, the more of a deal breaker it is for us. For what we like to do is we like to focus on collateral that we understand. So I think focusing on a project that you understand and you know well is going to make you more successful. As you move out of and try different asset classes, there's always that risk. There's an appropriate time and place to take that risk. Largely, it's you having the proper resources to take that risk. But from a lender's perspective, it's different, right? From a lender's perspective, we want collateral. We like low loan to values. I'll talk my clients out of deals if I feel if I feel there's too much risk in it. Clients, deals that will often be deal breakers are deals where clients try to reach. A perfect example of that is I might like a client to be at the 65% loan to value on a finished product. They might say, well, if I throw in the extra money and would you willing to allow us to do it up to 75, 80%? I might say no. Largely because it doesn't leave a lot of profit margin for that client. And if the client does poorly, that's something that I'll have to deal with as well. And it generally doesn't strengthen our relationship if a deal goes poorly. So, I think being honest with your clients about the deal, a willingness to say no is helpful to them.
So for you personally, since joining 1892 Capital Partners, it's been a few years for you now. How has the company evolved since you got there? Or maybe how has the company helped you evolve professionally? Is there been some give and take there? If you're looking back on your first 3 years on the job, what does that look like for you when you measure success and look where you've come from?
Well, we've achieved way more than we thought we were going to achieve in the past 3 years. Back to paying it forward and just doing the right thing as often as you can. I met the Corliss family, one of the brothers, about 15 years ago. Became friends. Didn't expect anything out of the relationship other than friendship. And then one day they said, will you help us do a loan? Right. And I did the loans, pay me later. No big deal. We're friends. Just whatever comes out of it, come out of it. Great. Mm-hmm. Then they asked me to do another one, and they asked me to do another one. And then eventually it turned into, hey, what would it take to have you come on board and do this full time for us? Right. And so we came up with a number and came up with a loan amount, sort of fund amount that we wanted to do. And within 3 years, we've, 300% what that was essentially. And we moved out of, when they first wanted to get into the business, we started with easy fix and flips and, things that's a little easier. Now we do land loans, we do acquisition development, we do vertical construction projects, we do bridge loans, we've done loans as low as $75,000 to loans as high as $12 million. We're looking at car washes, we're looking at RV parks. So yeah, it's been a really fun journey these past 3 years.
Yeah, that's an impressive expansion there. And that just goes to show how important a network is, right? A friendship, something that started very innocently with no intentions of progressing further, turned into a great partnership looking back on it in 3 years. So for as we talk about trends in the current real estate market, I mean, we could have an whole other episode about trends. The real estate market, the interest rates, inflation, it can cause your head to spin a little bit. But how are they influencing your strategies right now? Is that something that you take into consideration a lot, or is it kind of just your tried and true way, the basics? I know we've kind of talked about it a few times throughout the episode, but do the trends really significantly alter what you're doing on a day-to-day basis?
Right now they do. I feel every day, there's a certain amount of anxiety every day that I go through, always feeling like I gotta stay on my toes. When I was a wealth manager, we did a lot of venture capital, equities, things that were very complicated. And I wanted to go back to real estate because it's tried and true. The longer you do it, the better you get at it. And the longer you stick to it, the more successful you are. But this credit has become a highly evolving, quickly moving, completely opposite of what it used to be. And so we spend most of our time, what I would say, looking for those opportunities. I try not to compete because other people do things well that I just won't do. I can't do well, right? You guys are phenomenal at what you do. I can't do what you guys do. I have to navigate the cracks and crevices to find out where the credit gaps form as everybody shifts and moves into different spaces, right? And so it's constantly evolving. We were doing fix and flips, and they became highly commoditized. We went to new construction, that's becoming highly commoditized. So we went back to land because everybody ditched land when rates went up. Yep. There's a problem in land development, but there's all this vertical money that wants to fund it, but now there's no lots. So we're heavily into that space, right? And then there's so much vertical money, it's hard for us to compete there. So we looked at bridge loans. Now then bridge loan money started coming out, so then we kept looking. And so now we're looking at interesting asset classes like car washes and RV parks, areas where there's gaps. But yeah, it's constant. It's not boring.
Yeah, you got to adapt quickly and aggressively.
We're a little nimble, but we just have to constantly be doing that.
So there's been some expansion, there's been some challenges over the past couple of years. If you have the moment to look forward, is there anything that you want to accomplish in the next couple of years? Any direction that you want to take it, or is it kind of just where the market dictates and you guys are just, focused on adapting after the fact, or is there something that you're shooting for, reaching for?
Yeah, I think we'll continue to be the adapter. Let's call it that. There's been discussions because we go so fast and we're always overfunded. I mean, I always have more deals than I can do. Do we want to go raise some money? Do we want to do that? Do we want to deploy more of the family's money into this line of business? I think we're right size. I think that's the issue, right? Every company has to right size itself, and the younger side of me says, let's grow it into something crazy. But then the older side of me says, the wiser, intuitive side says, right size yourself. What's a right size that can give you balance? We're not driven by shareholders or investors. The nice thing about work for family office that has really great values is we're all about balance too, right? And there's, live one life and enjoy it. And so I'm in a fortunate position where they're always asking me, what do we want to do? What do we think's best? And I find we're always pursuing that balance, that right size.
Speaking of balance, I love ending every episode with a question regarding that personal and professional balance, right? Is there a specific passion project out there that keeps you motivated? Is there just a hobby, a leisurely activity? What is something that you can do outside of work that you feel like refreshes, recharges you, and allows you to have that same energy? Because as you mentioned, with your position specifically, the industry as it currently stands, it's nothing but chaotic, right? So there needs to be that moment where you take a step back, you kind of decompress, and then you're ready to go again. What is that for you?
It's a good question. When I was younger, I was always looking for that because it was always high stress, always high anxiety, and I honestly couldn't really find it. It was just constantly just trying to manage that. And then I had a family, so it becomes easy at that point, right? My family is the best thing. I have a little girl; she's 7. Any spare time I have, I want to go spend it with her, right? And so that keeps me balanced and it keeps me driven during the difficult times when it's hard to get up and do certain things. You just do it. And I'm very fortunate to work for a family that a family office that values that. So they allow me that. They allow me to build a life around that. So it's great.
So Charles, I want to thank you for the insight from start to finish. I think the last thing left to do is let people know how they can find you following the episode. You gave a lot of great solutions for new investors, some creative solutions to raise capital. I bet there's a bunch of people that want to reach out to you following this episode and, how can I get attached to 1892? How can they help me? So what's the best way to find you guys?
So we're pretty flat. I'll be happy to take as many phone calls as I can if people want to call me directly. Best way is probably to start by email. So my email is charlesf@1892capital.com. Send me an email, send me your name, send me what your situation is, and I'll definitely try to give you a call back and see what guidance I can give to you. Really, I'd like people to call just about deals. If you have a situation where you're trying to understand what you should do, or I'd be happy to make, like I said, those mentoring, those pay it forward phone calls to try to help people. Yeah, if I don't call right away, though, then just give me a little time to catch up. Yeah.
Charles, thank you so much. For our Uncontested Investing listeners, there you have it. Somebody that's willing to help, somebody that's seen it all pretty much in this industry. Charles Farnsworth from 1892 Capital. Thank you for joining us. We'll see you all in the next one.
Thanks so much. It's been a pleasure.
Thank you for listening to Uncontested Investing. Questions about today's episode or the podcast? Email podcast@rcncapital.com and make sure to follow REI Inc. magazine on LinkedIn and Facebook, and RCN Capital on Instagram, LinkedIn, and Facebook. See you all next time.